Is an 8% withdrawal rate too high? That seems to be the debate that Dave Ramsey has brought to the table. Welcome to our channel, folks. This is unique. There's nothing else quite like it on YouTube. We provide you with a wealth of information by looking at financial concepts like sequence of returns risk, impact of compound growth, the importance of your asset allocation, the impact on inflation. In this video, we're actually looking at an 8% withdrawal rule. The 4% has been standard for decades, but what about 8%? What we do on this channel is use the actual historical returns for the S&P 500. So let's go ahead and look at this. Let's say, for example, we'll just go with 750,000, and that would be 5,000 a month would give us the 8% rule. This is the amount right there, 8%. 5,000 a month would be 60,000 a year, and that'd be 88% of 750,000. We want to do a 60-40 asset allocation, 60% stay in the S&P 500, 40% going on a cash reserve account. So when the market's going down, these funds aren't coming out of the market, which is already going down. You don't want to sell low. So we're going to have that coming out of a cash reserve account. Now, how many times in the last 100 years would you run out of money with this scenario, with this 8% rule? Got the year 2000 shown, and you can see in that case with 3 down years, I call that sequence of returns risk. When those first few years are down years, you're going to run out of money really quick, especially with the 8% withdrawal rule. In fact, in this case, you'd be out of money in 11 years. Well, let's go ahead and update this. And as it's updating, I'm going to show you. This is the amount you have left after 10 years, 20 years, and 30 years. After each of these years, beginning in 1925, we're looking at the returns from 1925 on. And I want you to notice how many times you'd run out of money. 57% of the time. Here's the actual graph. More times you'd run out of money than the times you'd have money left with the 8% rule. Just doing that simple. That's with a 3% COLA, by the way. Let's see if the 2% COLA makes much difference. Going from a 57% failure rate, again with a 60-40 split, 57%. Now we're just going to do a 2% COLA, changing that COLA just a little bit. Now you're down a little bit less than half the time you'd run out of money. But folks, do you see this 8% is just too high? It's just too high given what's happened over the last 100 years. Let's go down a little bit. Let's go down to basically 7%. Let's see how that would affect. The 8% rule just does not work out very well. Let's go with 7%. See how much difference that would make. Right now we got with a 2% COLA, 47% of the time run out of money with 8%. How about a 7%? Now we're 30%. Still, a lot of people would be uncomfortable with that. A lot of those during the Depression years, but also during the late 60s and early 70s, and also in the around the year 2000. These are the numbers that we're actually using. You can see it just makes sense. When you have down years like the Depression years, you're going to have a problem with it 7%. You can have a problem with the 7% even if you have 2 down years like we had in 1973 and 74, and also as recently as the year 2000. We can see this graph, how many times you'd have problems with 7%. Let's go down to 6%. Again, the 8% is just too high. How about, let's see, we'll go with 3,800, which is 6.08%. See how many times you run out of money there. Again, we're just doing a 2% COLA, folks. If we do a 3% COLA, these numbers would be even worse. 6% withdrawal rate. Now we just got a 9% failure rate. A lot more livable because that means 91% of the time, look at all these times you wouldn't run out of money. In fact, oftentimes you have way more. You could take out more. This is $1 million, $2 million. This is all with the 20-year graph. After 20 years, you can see you'll be in just fine shape with the 6% withdrawal rate, unless we had returns like year 2000. Year 2000 with these 3 down years, you're out of money in 15 years given these numbers. What could we do differently? Also, I'm not really comfortable with a 2% COLA. Let's go with a 3% COLA. That's going to make this 9% look a little bit worse, but what we're going to do is something else to alleviate that a little bit. So 6% withdrawal rate. Okay, we got a 22% failure rate, which I just went from 9% down to 9% to a 22% failure rate, just going from a 2% COLA to a 3% COLA. But let's do one other thing. Let's start changing some things. How about if the market's going down you actually take a negative COLA the year afterwards. Right now, we got a 3% COLA going down all the way through here. Let's say, for example, after a down market, you have a plus, you have a -3 whenever there's a down year. Instead of taking a 3% COLA, you'd take 3% less the next year. If you had consecutive years, you have down 3 and down 3. Let's see how that might change this 22%. We're just trying to find some level that you can live with. If you needed 6%, if you need $3,800 on this 750,000, look at that, folks. That made all the difference in the world. Now you just got a 4% failure rate. What was it before? I already forgot. I think it was 22% had a failure rate. But once we changed this COLA from a 3% straight through, but after a down year, this is called kind of using guidelines to change how much you're taking out each year. So instead of giving yourself a 3% COLA after a down year, you actually take a 3% cut. Actually, if we do a little bit more adapting, if we change this to 5%, actually 4% is not bad, a failure rate. That means 96% of the time you're fine. I'm just seeing we can find a scenario where even in a bad, well, now you still got 2% of the time. So it looks like right here is probably about the best case scenario you can do. 96% of the time you'd be in just fine shape using numbers from the last 100 years. That's with a 6% withdrawal rate. If you're willing to take negative COLAs after down years, looks like your money would survive after 22 years 96% of the time. The only time you'd have a problem is the Depression years and around the year 2000, and we have the 2000 years showing right here. You're out of money in 18 years, 2001. Out of money in 18 years, 2002. You have a little bit left after 20 years. So if we would happen to have returns as recently as what we've had in the last 25 years, where we had these 3 down years, you might have to do some more major adjusting if you're withdrawing 6% and you wanted to do negative COLAs of -3. But folks, that's what we do on this channel. We run all kinds of different numbers just to see what you might do differently. Again, in the year 2000, you're out of money in 18 years. If we go to a 2% COLA, this is a summary box, by the way. You can see you're out of money in less than 20 years. If we go to 2% COLA, you got $5,000 left after 20 years. You go to 1% COLA, 93,000. Here's the only way your money's going to last over 25 years is not take a COLA at all, and after negative years, take a -6% COLA. So that's pretty drastic, but if that's what you see is happening these initial years, that might be what you have to back up to do because of what's happening in the market if you have these 3 down years. We can run all kinds of different numbers, but hopefully we saw this 8% rule is just not going to cut it. It just fails too many times. And again, we've used the numbers for 100 years, and we saw running out of money half the time using the 8% withdrawal rate. 7% was a little bit more bearable, but here's 6% with a 4% failure rate when we do negative COLAs. What we were doing there was we were doing -3 after negative years and +3 after positive years. So that's what we do in this channel. We run all kinds of different numbers. Hopefully these numbers kind of make sense to you, but again, you don't really want to go much more than this 6%. Start getting up to 7 and 8%. You're having a lot higher failure rate. You'd have to really change and really increase your negative COLAs if you wanted your money to survive. That's granted. This is rare to have 3 down years like this, but if you would happen to do that and retire, you'd have to do something quite drastic to allow your money to last. Again, in this case, you're running out of money in 18 years if we had 3 down years given all these different numbers. But folks, that's what we do on this channel. We run all kinds of different numbers. And we set up spreadsheets, kind of answering some of these questions. And we just look at some of these concepts and develop spreadsheets to educate you on how they all might work out using numbers, actual returns for the last 100 years. Please consider subscribing. Please share. Please like the videos. And thanks so much for watching.